Hey guys, welcome back to the Multifamily Investor Playbook. I'm Mark Faris, and I'm here with my co-host John Makarewicz. The mission of the show is to be the ultimate guide for high net worth multifamily investors. Today, we're going to be talking about the different asset classes when it comes to investing into multifamily properties. The problem is each asset type, when it comes to the building and location, has its advantages and potential downfalls. So it's really important to understand each one and to be able to factor in the potential downside or risk that comes along with the returns that you get for each investment. Today, we're going to be talking about an unbiased approach. So we're going to be looking at all the different asset classes that are out there, and we're going to be unbiased when we talk about the advantages and disadvantages of each, because you can make money ultimately in each asset class. John, it's really great to be here with you.
Yeah, Mark, great to be here as well. It's been a great week, and I just finished this really interesting book, and I thought I'd share a little bit with you about it. It's called Range by David Epstein, and it made me think a little bit about, and really the thesis is that for years the advantage was to be a specialist and to really understand one thing and one thing really well. But now science is starting to show that given how fast things are changing, it may actually be better to be a generalist. So there's some really interesting data points in there. So for example, John Makarewicz did not zero in on tennis as his main sport until late into high school. He actually played every other sport as well: baseball, basketball. And, he dialed into tennis as he got kind of into his, later teenage years, and now became one of the greatest tennis players of all time. They talked about music students who focused on one instrument versus multiple, and those that focused on multiple tended to be excelling even at their chosen instruments. So say, for example, piano. So it's a really fascinating read and really challenged some of my thinking as well. But I know a lot of our listeners are high net worth entrepreneurs, made me think about a lot of our investors and people that we, you and I currently know in our own spheres of influence that have touched multiple industries and worked in many different roles, and how that actually gives you an edge because you can solve problems in more creative ways. So it's one of those books when I put down, I was like, gosh, I'm going to definitely be rereading that one again, but really fascinating stuff. And, like I said, a book I would recommend to a lot of our listeners on this podcast here.
Well, a couple of thoughts on that. I mean, Wayne Gretzky was not only played ice hockey, but he played lacrosse and he played different sports in the summer. He didn't play any summer hockey. That's an interesting thing for all the Canadians and the Northern Americans that, play ice hockey. It's one of those things that doesn't mean you necessarily need to play in the summer to be the best. And I mean, Wayne Gretzky was the best and he didn't play. Yeah. The other thing that was interesting, that when you say that, it's funny, I find with most business people, and I know for myself, is I specialize and then I generalized, if that makes sense. It's like you get really good at one thing, you become an operator at one thing, and then you get so good at it that more and more people want to use you. And then you got to start figuring out, I got to be a manager, and then, I got to be a business leader, and, I need to learn about marketing and, operations and, finance. Cash flow is important, right? So then you start to generalize across. That's an interesting thought that you had. So I'll definitely check that book out.
Yeah, it was a fascinating read for sure, but definitely excited to jump into this topic. As you mentioned at the top, all of these asset classes, have tremendous opportunity, and it'll be fun to go through them and really talk through, as you said, in an unbiased way, some of the pros and the cons, the advantages and disadvantages of these different approaches. And then, we'll kind of wrap a bow on it at the end with the asset class we prefer, but that's just us. That's just the one that we've dialed into and feel that we excel at. So it's going to be a good conversation. I'm looking forward to it.
Yeah, for sure. And that's the idea today is, we'll take unbiased, and then, we'll mention which one is our favorite here at the end. And then actually we'll have another episode where we're actually going to dive a lot deeper on that. But basically, guys, there's two different ways that you can categorize asset classes when it comes to multifamily. So there's the property type, okay? And then there's the location. And so both of them can be ranked as an A, B, C, or D. So it can be an A location and a C building. It could be a C building and maybe it was just a D area, right? And so the goal, we'll talk about kind of the different goals to be able to find the best upside. And so in general, you want to be able to find something that's in a better location, but a building that's maybe in a lower grade that you can upgrade it, but you can change the building, but you can't change the location per se, right? So we'll be diving into that a little bit more as well.
That's right. As they say in real estate, location, location,
Yeah.
location.
Well, 100%. Well, let's dive into Class A multifamily. So we'll talk first about the location. And so here are some of the main things when it comes to Class A location. So these are prime locations. So these are urban centers, so affluent, suburban areas, or highly desirable neighborhoods. So these are like the premium locations. It's like that's an A class location. So your proximity to major employment hubs, you got transportation, you got shopping, you got the best entertainment around, and it's highly walkable as well. So you can get up, you can walk down to all the entertainment close by you and all the amenities in your area.
That's right. Yeah, those amenities, and I think today with dual income families being more and more normal, when people get off work, they don't want to have to work to live, right? They want to be able to have easy access to, you said entertainment, but restaurants, shops, movie theaters, sporting events, anything of that nature. So, those A-class, pockets are the most highly desirable, but they do come with challenges, right? Because with that, you typically have a higher cost of living, right? So usually the market has a much higher average or median home sales value. And so it does limit some folks from having access to those areas.
That's right. And so in general, you're going to be paying, you're going to be paying a higher per unit cost with that. And in general, you're not going to find, especially in premium areas like that, you're not going to find as much upside in value add in general. Because there was such a premium to buy them, and generally they're newer as well. So there isn't a lot of maintenance and upside potential in them. So in general, they're pretty good you're buying them for cash flow, but primarily it's cash flow and appreciation. But those areas do go up pretty quick as well when the market increases, because there's a flock to quality, right? And so that's where those properties do fairly well, but you just don't have that, value add high upside by going in, renovating and increasing rents the same way as
That's
a lower
it.
class building
Yep.
and location. So let's just say, so that was on the location side. So let's talk a little bit more about what makes a class building. So what are the characteristics, John, for an A class building?
So yeah, typically for a A-class building, you're going to be looking at newer to new construction. The building itself will typically have robust amenities. Today, you're seeing buildings that have coffee shops, in some cases, maybe even a Starbucks location within the building. Some of these buildings, 400, 500 units, have enough to sustain that. In urban areas, you might even see the building with a full suite of retail shops at the main level, right? So whether that's a grocer, coffee shop, as I mentioned, or some retail opportunity. But a lot of operators in these newer A-class buildings are even putting in co-working spaces. You're typically seeing things like pool rooms and reading rooms, and so those amenities are very important. And part of that is that often to build these A-class buildings with today's increased cost, the units tend to have a little bit of a smaller square footage, so you have to make up for that in amenities outside of the unit, but also in the unit. So you're going to see high-end finishes like granite or marble countertops, brand new cabinetry, of course, with those easy soft close drawers, really nice hard surface flooring, brand new stainless steel state of the art appliances, and a really just a modern architectural approach. So over the past 20, maybe even 30 years, open floor plan concept is kind of popular. So you're going to see a lot of those things that that flight to quality you mentioned. that buyer or that tenant, that resident is looking for. So those are the main things you're going to see that really, make an A, class building stand out. And as you said, that A class building might be in a B or C location, of course. But you're going to see those extra amenities that maybe the B and C and D class buildings do not have.
Right on. So yeah, so either newly built or, up to say 10, 15 years, depending if it's maintained well, you're going to get higher ceilings. So, 9-foot ceilings, and yeah, you might even get a concierge there at the door, right? And out front. But so that gives you a pretty good understanding of A class locations and then A class buildings as well. So let's get into a category that we really like. We love the Class B multifamily. So location-wise, John, what would you say a B class location differs, say, from an A class location?
Yeah, so your B class locations are great areas, desirable areas, but they're a little bit more of a secondary market. So they might not be right in the middle of the urban center. You're going to see well-established neighborhoods, suburban areas that typically have more moderate growth versus high growth. So maybe that more established suburb. And some of the advantages that come from there is that often in those more established areas, it's hard to develop new buildings because maybe it's down to infill. But you're going to have decent to excellent schools. There's going to be access to public transportation, retail centers, but just a little less desirable than those Class A locations. These are areas that typically attract the middle to maybe the lower upper class demographic, right? So people that are making good, consistent income, but maybe not enough to get them into that kind of posh, high-end Class A location.
Yeah, right on. So yeah, I mean, it's still close to decent schools, public transportation, retail centers. So amenities are close by, but it, like John had said there, it's the serving more of the middle income residents there on that. So your rents could be, say, and it depends on the market, but from 1,600 to say 2,000, where an A class apartment could be 2,500 to over $3,000 a month.
That's right.
And so that's the difference between the two when it comes down to rent. So obviously you get more with higher rent, but you are paying more in general.
Correct. That's right.
All right, so let's keep going to the building characteristics of a B class building. So they're generally a little bit older, so from say 15 years to 45 years. So in general, we look at 1980 or newer because building code changed after 1980, where there's less problems, galvanized piping, aluminum wiring, and whatnot. So also better for resale, we found, because when you get into the 70s vintage, a lot of buyers have that concern, like, okay, you know what, there's more potential issues of maintenance. They're just built a little different, and it's going to be tougher when I go to sell down the road as well. So yeah, may lack some of the luxury finishes, right? So you may not get 9-foot plus ceilings, but there's still some B class buildings that still have 9-foot ceilings. But in general, most A class buildings, most of them have the 9-foot plus ceilings there. You're getting basic fitness center, so you're not getting like the luxury fitness center. Actually, John, that's actually probably a good time for us to talk a little bit about our Largo property. Why don't you share a little bit about what we were able to do with, say, a B class building, 104 units we bought in Largo?
Absolutely. So, the fitness center that was there when we acquired the building was really an afterthought. It was maybe the size of a large walk-in closet. They had one treadmill, a couple weights, and one of the rack systems. And so, in talking to residents as we walk the property, that's one of the things we always do when we're considering to buy a property. We just introduce ourselves to the residents when we see them, and hello, how are you doing? How's your day? And if they seem open to it, we ask, how do you like the building? And we'll ask them about some of the amenities or things that they like or what they'd like to see. And that came up. So we realized there was a space just attached to the current fitness center but it was being used as a maintenance shed. And so we relocated that offsite. So, a couple of things. No longer does the maintenance tech have to walk through the leasing center to get, a piece of equipment or a tool to fix a maintenance item. So it's a better experience for the leasing agents and the residents that are in that space. But we effectively tripled the size of the gym. And so we brought in state of the art equipment, added a few more treadmills, a couple elliptical machines. We even brought in a nice refrigerator that we keep stocked with Celsius drinks, Gatorades, and waters. And some yoga equipment, yoga mats, and some yoga balls, and it's being used all the time. So we were able to take, what was basically an afterthought and unused space, and now turn it into something that our residents are using on a daily basis. So we're not quite at the level with the Pelotons and the mirror, kind of training things that some of the Class A buildings will have, but it still gives our residents an opportunity to get some exercise in before or after a hard day's work.
That's right. Yeah. So we're always looking in the B class space to, can you make it a little bit nicer than what they're used to? So what they're used to is kind of, a couple machines slapped in a room, and, that's where you can try to elevate it up even to like maybe like a B plus building by adding some of these features along the way where people are like, yeah, you know what, this is actually really well maintained on that. So it's know your market, right? So you're looking at, working professionals, middle income families, which they're phenomenal residents, right? They're just salt of the earth, but they appreciate value. They still like nice things like the stone countertops. They like the neutral colors, right? They like the open concept kitchen. And so this is where you can really go in, you can find a building perhaps like, C plus, and you can bump it up to like a B plus building by adding some of these things that we're talking about.
Yeah. Some other things you might see in a B class building, or maybe even just some deferred maintenance items, some dated aesthetics. A building we took down, it just was kind of yellow and green. So the colors just weren't up to today's standards. And so a fresh coat of paint can go a long way to sort of upgrade, from one class to the next. And so, the amenities being a big factor, we have a pool at one of our properties, but the furniture was dated and it wasn't really practical. It just, was some kind of like, lounge chairs and a couple of tables, but we put in some couches, some meeting areas, some nice umbrellas. Down in Florida, it gets quite hot, as we know in the summertime. So providing some shade goes a long way. But when you're looking at those Class B buildings, you'll often see that dated or deferred maintenance, which is another value add opportunity that we can do to increase the value of the building.
Well, John, this is one of the major advantages with our background selling real estate is the fact that, with you walk into a property, you buy a building like that is just, they're just offering very basic. You can go in and present a lifestyle through staging, right? So exterior staging, like what you were talking about in regards to the pool, facilities, the lounge chairs and the couches and whatnot, and in the interior where you can actually go and stage it properly, and you can really make a building come to life in a big way. Like, because a lot of these buildings are just like basic, and the mindset of the previous owner is like, okay, well, that's the asset class. But what we found is that if you go in and you just put like a stamp of like, wow on it, kind of like lipstick, right? It doesn't cost a lot of money, but just by that extra care and attention to detail, you really, I mean, John, we're seeing this now with our assets that are going in, and people are like, wow, on the renewal time where their rents are sometimes raising $400 or $500, are like, yeah, listen, I don't want, I love what you guys are doing here. I want to stay.
Yeah, 100%.
Yeah. All right. So let's move on to the Class C multifamily. So Class C location, John, how would you maybe differentiate that from the B class location?
Yeah, so those tend to be less desirable areas that have maybe experienced some flight where people have moved away. So homes in the area may have some issues. So aging neighborhoods, they could be maybe more in industrial areas or regions of the city where maybe there's very busy roads. You mentioned something with the building codes, but other things have happened where, areas that were developed in the 60s and 70s and even early 80s often didn't have the same zoning focus that today's city leaders might have. So you might see a lot more billboards and bus signage and things like that just kind of pull back a little bit on the aesthetics of the neighborhood. You also tend to see, unfortunately, slightly higher crime rates, right? So areas where maybe there's not necessarily murder and that kind of crime, but theft, car car theft, things like that, petty crime, all the way up to potentially, some shootings and things like that. You typically have limited access to higher quality schools, so the school scores are coming down in those areas. And a big factor in school scores often comes down to parental involvement. And so these are areas that are typically more working class, where both of the husband and wife or the two, spouses are working. And so they don't have time to volunteer and to put pressure on the administrators to bring the school scores up. Also limited access to public transportation and recreational facilities, so dated parks and rec, if it even exists.
Yeah.
It's really a product of an area that, maybe in one time had a heyday, but has kind of fallen off. People have migrated away. So you'll typically see lower to flat population growth in those areas. Now, what is interesting is that often those areas over time start to gentrify and kind of come back because of the affordability, and people move there and fix them up. But these are areas that, given the opportunity or choice or the income ability, people would tend to try to maybe avoid for that more B class location. So they're areas that are just, to put it simply, less desirable.
Yeah, right on. Yeah, you might see like pawn shops or like
Yeah.
dollar stores close by when you start driving the area. Beer stores, alcohol stores, right?
Right.
You're starting to see that sort of thing close by.
Yeah.
But yeah, that gives you a really good understanding of a C class location.
That's right.
All right, so now that we've talked about Class C location, let's talk about Class C building characteristics, John.
Yeah, so typically a C-class building is going to be 30 to 50 years old. Minimal updates or renovations have been done. More than likely, that property today is probably being utilized for low-income housing, and so that could be government, supported rent programs or things of that nature. And so it doesn't really incentivize the owner to, keep up with maintenance and updates and things of that nature. You're typically going to see very basic construction, no frill style construction, not a lot of amenities. In fact, sometimes what you'll see are, what looks like a concrete, sort of like, yard with just some, kind of very basic rectangular buildings dropped in the middle of it. Limited to outdated amenities. Once again, likely to see no amenities. And these are typically designed for more low income to lower income blue collar workers.
Yeah, right on. So, I mean, finding a C class or even like a B class building and wanting to bump it up, that is the goal here. But when you get down to the D class, which is the next stage, this is where you got to really ask yourself, is it worth it? Because, the returns are in general higher. Generally, there's higher cap rates when you go and buy it, and overall higher yield, but ultimately there's a lot more risk. So when we're talking about Class D location, we're talking about high crime areas, right? So they're economically depressed areas. There's high crime neighborhoods. There's poor access to quality services. They're generally in the areas with low performing schools. And there's high tenant turnover in these areas. So as soon as you think you're fine for occupancy, you could have a number of people move out because maybe there was a shooting or, there was some crime that was done. And so these need significant management, and you definitely need to have tough skin when it comes down to buying a building in a D class location. You can't change that, right? So you're in for the long haul.
Yeah, I mean, if you're buying a D-class building, you're more than likely betting on some kind of gentrification that may already be in process or that you're anticipating coming. Where I live in Metro Atlanta, there were some pockets 10, 15 years ago that, you wouldn't want to drive through in broad daylight, but because of some recent developments, there was a Beltline project built that, put a walking and jogging trails throughout the whole city, and that has spurred development in such a way that some of those areas have turned the corner and now become, more C or B, even B locations. But that's a big gamble that you're taking
Yeah.
because, there's often things that get in the way of that. And other considerations, right? There are folks that live in those areas that maybe have been there for 30 or 40 years. And so as gentrification occurs, property values increase, taxes increase, and it displaces people. So there's some political pressure in certain cities. It really depends on the local government that will actually do things to slow down that gentrification or that redevelopment. So, these are the kind of deals that you have to have a very, thick skin for, and, you're really shooting for higher return, but accepting a whole lot more risk. Investing in a D-class area. So it's not something we like to do here at Faris Capital Partners. We like to, in any investment, you have to have a certain amount of, you take your due diligence and all your research and everything you've done to analyze the deal. But, nobody has a crystal ball. So you do have to look forward a little bit and make some assumptions. But D-class just for us brings a little too much risk, but definitely opportunity there for investors with thicker skin. And I would say investors that are willing for a longer timeline on their investment returns.
Yeah, for sure. And you have to be prepared for, there could be shootings in the area, right? Like there, could be deaths and so that's all part of it. But another thing is the safety of your property managers, because they stay on site, right? So they're there throughout the week. In some cases, they have units where you can actually, as part of the compensation, you can give them a unit. And the challenge there is with safety being the number one issue. Like we have a concern because our property management team is part of the team, and we want to make sure that they're safe and protected. So you just really got to have a certain kind of dynamic and kind of, I'd say that you really need to specialize in these and be set up with the right team in order to execute these for long-term success.
Absolutely. And it's imperative that you're very familiar with the government programs that are available, whether that's, rent abatement or, contributions from the government for those low income tenants. You have to be able to navigate a lot of red tape with the bureaucracy. And so you're dead on. That's a class that there are investment groups that specialize in, do wonderful jobs in, but it does require a different acumen than what we, here at Faris Capital Partners focus on.
And finally, we have Class D building characteristics. So these are significantly older properties. There's a lot of deferred maintenance on there. Few or no amenities. I mean, with the amount of, we'll say the type of demographic and the type of residents there, you really are not set up to have a pool, because there's probably going to be a lot of chaos in the pool there as well. But you need substantial upfront equity when you acquire these properties to be able to look after all the maintenance and the repairs that in general have not been looked after to this point.
Yeah, and it's interesting, Mark. There's been some conversations recently at industry events in the multifamily space because ultimately, everybody deserves livable housing accommodations, but the economics of owning a building like this, it really, you can't go in and renovate every unit to modern standards, because by doing that, you're not able to raise the rents in such a way to recapture that investment. And so, I'm hoping that over the next few years, we see, the federal government provide some tax incentives to owners and operators of these buildings to offset some of that expense, because, once again, you might be dealing with a building where the plumbing system is, consistently failing, or the, furnace and the heating is not really working properly. And so, you hear about the slumlords, but it's often, an incentive that is not there for the owner or operator because they'll lose money doing it. So I think more needs to be done to help support these owners and operators. But yeah, you're dealing with high delinquency often. And candidly, those buildings tend to have a higher instance of fraud. In other words, where tenants come in with fraudulent pay stubs and tax returns and rental histories. And so, you can kind of deal with that in any asset class. We actually leverage software that, while not being perfect, can detect things like, artificial bank statements and pay stubs. But it's getting harder and harder. There's whole websites you can go to as a what we call a professional tenant, and get sort of a fraud kit. And so the software is having a hard time keeping up with it. So, that vacancy issues, the delinquency challenges, all make Class D building investing a lot more challenging.
Yeah, that's right. So there you have it, guys. So in an ideal world, you are buying something that has strong upside, yet when it is completed, when it's fully stabilized, you are looking at a building that you could be proud of. And that's one of actually the qualifications for us, is we want to be proud of whatever it is that we're going to be buying, and we got to be able to get it up to our standard, or to our, par is for us. So just some closing key takeaways here. You have A, B, or C, or D for locations and building types. The lower the quality, the higher return in general, but there's the higher the maintenance as well. So you should definitely make sure that you are balancing risk and reward with that, and just know that anytime that you are going after something with a higher potential reward, there's more risk there. So this is where your operational team is like critically important. It's huge. So unless you buy in an area that's rapidly changing, so the area can't be improved, right? So you could be on the path of progress, but as John was saying earlier, sometimes things can change, right? So there's a lot more risk with that. And then, the goal should be to buy a property in a higher grade location with maybe a lower grade building that you can go and renovate, and then you can push it up, a grade. So you can push it up from, say, a C to a B, or potentially like a B minus to like a B plus or an A minus, right? So you always want to be pushing it up a level if possible, to be able to, get ultimately higher rents and higher returns.
And the reason that strategy works so well, as you know, Mark, is that you said something earlier. An A building in an A location could be upwards of $25,000 to $3,000 in rent. So if you find a B or C asset in an A location, and you run a value add program, and you enhance the amenities, bring the units up to more modern standards, now all of a sudden you provide something of value, where the resident who's looking at two options can say, well, gee, I get basically the same thing over here. Yeah, the building might be 20 or 30 years older, and maybe it doesn't have all the bells and whistles of that brand new, in terms of the amenities and some of those things we mentioned, but I'm able to get it for $1,800 or $2,000 in rent, as compared to $2,400 down the street at that newer building. And so that positions yourself really well to make sure you're attracting residents and maximizing your occupancy and your income.
Yeah, well said, John. Well, there you go. You have all the different asset classes there, guys. So just know when you're investing in, what your asset class is for both buildings and location, and to be able to properly balance risk and reward. Thanks for listening, guys. If you enjoyed the show, please subscribe and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.